Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Jetblue Airways Corporation Annual Report. Jetblue Airways Corporation offers a wide range of businesses and services to its customers. At the core of its operations is air transportation, providing flights to over 112 destinations across various regions including the United States, the Caribbean, Latin America, Canada, and Europe. The company operates a diverse fleet of aircraft, including Airbus models such as A320, A320, A321, and A321neo. In addition to air travel, JetBlue also offers airport lounge services, providing customers with a comfortable and convenient experience before their flights. Furthermore, the company provides vacation services, catering to travelers who are looking for more than just a flight. This comprehensive approach allows JetBlue to cater to different customer needs and preferences, setting it apart from other airlines in the industry. Overall, JetBlue's diverse range of businesses and services makes it a one-stop shop for travelers seeking air transportation, airport amenities, and vacation packages. Unfortunately, I do not have access to the text you provided. However, I can still provide a general essay on what may cause a stock price to drop. The stock price of Jetblue Airways Corp has dropped significantly over the past year due to various factors. One major reason is the ongoing COVID-19 pandemic, which has severely impacted the airline industry as a whole. With reduced travel demand and strict safety protocols in place, airlines have been forced to cut back on flights and staff, leading to significant losses. Another factor contributing to JetBlue's declining stock price is increased competition from other low-cost carriers. As more airlines enter the market, they offer cheaper fares and better services, making it difficult for JetBlue to maintain its competitive edge. This has led to a decline in passenger numbers and revenue, further exacerbating the company's financial woes. Additionally, rising fuel costs have also taken a toll on JetBlue's bottom line. With oil prices increasing globally, airlines are forced to pay more for fuel, which is one of their largest expenses. This has put pressure on the company's profit margins, making it even harder for them to stay afloat in a highly competitive market. Lastly, regulatory issues and lawsuits have also contributed to JetBlue's declining stock price. The airline industry is heavily regulated, and any changes or updates to these regulations can have significant impacts on airlines' operations and finances. Furthermore, lawsuits against the company can lead to costly settlements and damage to its reputation, further eroding investor confidence. Overall, a combination of factors has contributed to JetBlue's declining stock price over the past year. While the airline industry is expected to recover in the long term, investors will need to closely monitor these developments to make informed decisions about their investments. Jetblue Airways Corporation market capitalization of $2 billion is materially smaller than most of its industry peers of roughly $6 billion. Jetblue Airways Corporation trades at a lower price-to-book ratio of 0.92 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 84% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for a company can be attributed to several key factors. The launch of premium services such as Mint Registered and domestic first-class experience across non-Mint registered fleet has contributed significantly to revenue growth. Additionally, the adoption of cutting-edge technology like Amazon Leo's Wi-Fi and satellite broadband network has also driven revenue upwards. The expansion of airport lounges, introduction of premium credit cards, and opening of new routes have further boosted revenue. Moreover, increased on-time performance and customer satisfaction have led to a rise in customer loyalty and retention, resulting in higher revenue. The company's collaboration with United Airlines for interline agreements and reciprocal benefits has also contributed to its growth. On the other hand, the primary drivers of revenue decline include seasonality in leisure travel during economic downturns, softening demand, and Pratt & Whitney engine inspection requirements that resulted in aircraft groundings. The Embraer E100 and 90 fleet transition and retirement have also led to a net loss of $32 million. The net income of a company underwent significant fluctuations between 2023 and 2025. Initially, it decreased by $485 million from -$310 million in 2023 to -$795 million in 2024. However, the following year saw an improvement of $193 million, resulting in a net income of -$602 million in 2025. The profit margins also experienced changes during this period. The operating margin worsened from -2.4% in 2023 to -7.4% in 2024, before improving to -4.1% in 2025. Similarly, the pre-tax margin declined from -3.5% in 2023 to -9.7% in 2024, but showed a slight improvement to -8.5% in 2025. The reasons behind these changes can be inferred from the text, which mentions uncertainty around global minimum tax rates and increased costs associated with complying with foreign laws and regulations as contributing factors. These external pressures likely had a significant impact on the company's financial performance during this period. Based on the extracted summaries, it appears that the company's operating cash flow is not consistently stated as negative across all pages. In fact, there are conflicting statements regarding the company's operating cash flow for different years. However, one clear statement stands out. On page 84, it is explicitly mentioned that the company has positive operating cash flow in both 2024, $144 million, and 2023, $400 million. This suggests that despite some fluctuations, the company is generally generating positive operating cash flow. The company's debt level has undergone significant changes over the past few years. Initially, the debt level decreased by 44% from $20.4 billion to $11.5 billion as of December 31, 2026. However, a closer look at other metrics reveals that long-term debt and finance lease obligations actually increased from $7.7 billion to $8.1 billion. Furthermore, total debt and finance lease obligations remain stagnant at $8.6 billion. In contrast, interest expenses have seen a substantial increase in recent years. The company's interest expenses rose by 60.8% in 2025 compared to the previous year. This trend is consistent with earlier years, where interest expenses increased significantly from -$210 million in 2023 to -$365 million in 2024, and then further to -$588 million in 2025. The performance of various segments and regions within a company has been analyzed. The Caribbean and Latin America region showed significant growth, with an increase in market share from 33.2% to 36.5%. Florida also experienced growth, with its market share rising from 23.7% to 25.4%. In contrast, the transcontinental segment saw a decline in market share, dropping from 29.9% to 26%. The Atlantic region in Europe performed well, with revenue increasing significantly. However, some regions struggled due to various challenges. The San Diego airport faced issues related to noise curfew limits, while 4 U.S. airports, Ronald Reagan Washington National, LaGuardia, JFK, and Newark, were impacted by congestion and delays. Additionally, the environmental segment experienced difficulties due to regulations on emissions, aircraft noise, and climate change. International operations outside of the United States and Canada also faced increased risks due to CORSIA compliance costs. These challenges highlight areas where improvement is needed to enhance overall performance. The management of Jetblue Airways Corporation is optimistic about the company's outlook despite facing significant challenges in the airline industry. According to the annual report, the company aims to capture premium revenue through product enhancements and partnerships, and is investing in Paisley, a full-service travel services company, to drive high-margin growth. To achieve its goals, the management plans to continue increasing expenses due to wage rate cost pressures, aircraft acquisition, and fleet aging. However, they believe that their financial resources are adequate to execute their growth plans and may seek additional financing through issuing shares, debt, or other equity securities in the future. The company is also focused on managing various risks associated with its business, including economic conditions, competition, fuel prices, interest rates, and cybersecurity threats. To mitigate these risks, they have implemented measures such as investing in AI and data science technology, implementing cost-saving initiatives, and prioritizing cybersecurity. Overall, the management's strategy is centered around delivering reliable service, building its network, offering premium products, and providing a secure financial future. They aim to maintain a healthy liquidity position and be prudent with capital spending while navigating the challenges of the airline industry. The acquisitions and divestitures of Jetblue Airways can be summarized as follows. Acquisitions include the purchase of new aircraft and related spare engines, which is a strategic move to enhance the airline's fleet and operations. This acquisition is aimed at improving the airline's capacity to respond to global emergencies. On the other hand, JetBlue has made several divestitures in recent years. One notable example is the sale of certain assets of JetBlue Ventures, JBV, to Sky Leasing in May 2025. Additionally, the airline terminated its merger agreement with Spirit in March 2024, resulting in a significant write-off of $532 million. JetBlue has also rebranded one of its business units, JetBlue Travel Products, to Paisley, LLC, Paisley, which is not considered a traditional divestiture. Furthermore, the airline sold its Embraer E190 fleet, including 25 airframes, 60 engines, and related spare parts, as well as full flight simulators related to this fleet. It's worth noting that JetBlue's Northeast Alliance, NEA, with American Airlines Group, Inc., was permanently enjoined effective August 18, 2023, which is not a traditional divestiture, but rather a regulatory requirement. Concerns about the stability of a company's operations have been raised due to potential supply chain disruptions. Specifically, fuel availability is vulnerable to price fluctuations and shortages caused by limitations in refining capacity. Furthermore, there are risks associated with counterparty default in fuel hedging contracts. Despite these concerns, there is no clear indication that inventory buildup poses a significant issue. A mention of air traffic liability on page 70 does not relate directly to supply chain disruptions or inventory buildup. That concludes the financial summary for JetBlue Airways Corporation. Feel free to comment below, and I will be happy to answer them when possible.